London. Anyone who has rented or bought real estate in that city knows just how outrageously expensive property prices are. So it should be as no surprise when the Financial Times newspaper reports that the value of UK commercial real estate debt in default or in breach of key lending agreements more than doubled to about £30 billion in the first 6 months of the year. This adds enormous pressure to the banking sector because according to a recent survey by De Montfort University, which puts the total outstanding debt in real estate sector at £224 billion. The survey goes on to say that banks have also extended or refinanced an extra £16 billion in first half of the year, rolling over maturing debt that could be paid back by cash-strapped borrowers. Okay, more on this. We are chatting with David Buick, Senior Strategist at BCG Partners in London. David, afternoon. Sounds very scary. Does this De Montfort University survey actually reflect the true picture of what's going on in the UK's real estate industry?
I mean, this has been a very tricky time in the UK, particularly when you've seen so many shopping malls decimated by people unable to pay the rents. And I think the property companies have found it extremely difficult to make sure that they've got sufficient rents coming in to be able to service their debts. And I think the situation could possibly even get worse in the end of the first quarter of 2010. So this report from the De Montfort University doesn't come as any surprise to us at all.
David, a lot of exposure when it comes to banks. What's the nature of those losses?
Well, it's quite difficult to actually allocate the banks, but I suspect most of the high street banks that we've got here, you know, whether it be HSBC, Lloyds, Barclays, Royal Bank of Scotland, they will all be involved to some degree, because property has proved to be an extremely profitable arena for them. And it's only when the economy fell off the twig in October of last year that we actually saw many of these shopping malls and office blocks and everything else, just people leaving. So I wouldn't actually like to focus exactly amounts of money against, but there'll be also many European banks, whether it be BNP Paribas, SocGen, Deutsche Bank, possibly even Santander, through their branch of Avi National and the rest of it. There will be plenty of them, and I think very unlikely that many will be excluded.
Now, David, all these banks you're talking about, how are they dealing with the sheer amount of loans that really cannot be repaid? Also, can they expect any sort of government help? Is that needed?
I think we've had a system going through now for 18 months on the question of write-downs and valuations. I think it created a huge problems initially, starting off in North America 2 years ago, when, you know, the attempt starting off with Lehman's to say how much money they'd lost through subprime lending was clearly an economy of the truth. I don't say it was intended, but that's exactly what happened. And now I think we're seeing banking empires becoming even more vigilant than they were before. And they're probably writing down things excessively. So what we've heard today from De Montfort University in terms of possibly being a £30 billion shortfall, I think you'll find provision on most banks' balance sheets have already been made. Do I think the situation will get worse? Marginally. But I think they're more than capable of covering the situation because, as I say, write-downs is now a key issue.